Hey guys, Bob with Trade Genius. Got my good friend Phil here. Look, I think we're beyond dispute where the economy is going. It's not good. We're going to show you more data points. Buckle up.
Trade Genius.
Hey everybody, it's Bob with Trade Genius. Usually I do fun ads. I talk about our service, but I want to be serious with you for a second. We've been helping a lot of people trading for a long time. As you can see here, I want to let them do the talking for me for a change. But most importantly, we want to help you too. If you've not joined our service yet, come check us out, tradelikeagenius.com. Full service. We have chat room. We have the algorithms for you. We give trades out every day. We educate you. So go to tradelikeagenius.com. Check us out. What you get out of our service is much, much more than what you put into it. And we'd like to see you in the room. Thanks for listening. Okay, Phil, we have another leading indicator that has a high correlation for future market trends. And then we also got some more bad consumer data. I'm going to throw it over to you. Take it whatever direction you want to go.
Yeah, and I think all of this, by the time we're done with this video, there shouldn't be any doubt where this is all headed and why we want to really take advantage of any kind of exit pump that we see over the next couple of months. But diving right into the chart, this is the California unemployment rate in white, and this is overlaid with the national unemployment rate in orange. And one thing you'll notice is that once the California unemployment rate starts to go, the entire country starts to go. And, it makes sense because California is a large chunk of the GDP, right? And so it would make sense that if their economy is starting to erode, that's just a larger reflection of the overall national economy. But you can see a really strong spike here on the white line. Actually, even going back to the 70s, this is probably the widest divergence we've seen. So there's a big jump in this. And I don't think we're going to, is it different this time? I see no reason why it would be. I think this is just a big leading indicator for you to basically know that over the next coming months, I think we're going to see the unemployment rate continue to climb for the whole nation. Bob.
Yeah, and when I first started charting, I started to laugh because I thought it was those were all the realtors in California that just went out of business.
Right, because of that new ruling, right? And that's definitely going to take a big hit on that class of worker. The other one, Bob, too, was this comes straight from the Fed. The Fed, as much as they talk out both sides of their mouths, the data. They do provide you real data, and the real data is all you need to know. This is the Kansas Fed Labor Market Conditions Index, or LMCI. And again, that's in white, and it's overlaid over the U.S. unemployment line in red, very similar to the California chart, where again, it's starting to lead up. And, both of these measurements usually move in tandem. But it's interesting because we're getting such a sharp move higher also in the labor market conditions index. So the higher that goes, that's actually an inverted chart. So it just makes it easier on the eyes. But basically, it's taking a dive, and that usually means that unemployment's going to kick up relatively soon, Bob. And then the final chart, you and I were looking at this prior, is transition into serious delinquency by loan type, 90 plus days out. We've shown you guys 30 plus days in the past. Now we're going 90 plus days. The big loser here is credit cards. They're spiking really quickly. That jives also with that personal interest payment being at all-time highs. And I think it just proves the fact that more and more people are not meaningfully employed, Bob. And first thing you're going to do is go to your lines of credit, which is typically credit cards. And that's why personal interest payments are so high, because credit card interest rates are just out of this world right now. And we also have auto loans are starting to creep up. And we know the auto industry is really, new car sales are collapsing. And that's why you're seeing companies like Toyota and Tesla actually, even though we have APRs that should be at 6 and 7%, they're actually doing their own financing in-house at anywhere from 0 to 1% if you have good credit. And the only reason why they'd be taking that kind of a haircut, because that's costing them a lot of money, is just to move cars that they're producing. So I think we got a real big problem with the consumer here. And like I said, any benefit in the stock market at this point going forward over the next couple of months, consider it a gift to get out.
Yeah, look, you have the real estate market is an apex sector that feeds a lot of jobs. I think it was like 14% of employment is wrapped up in real estate in one way, shape, or form, from builders to services to sales. The second biggest one is autos, Phil.
Yep.
And so we're destroying the two biggest market segments in the country. And unemployment in the auto markets are going to absolutely go insane here because of just the lack of activity. They're going to start hollowing pulling out a lot of these dealerships. So it's going to be pretty wild. And, it's the interesting thing, about this is that you got the real estate market that's stuck, you got the auto market that's failing, and then you got basically services that are being bought on credit everywhere but the cruise industry right now. But I'm starting to get notices now and ads basically trying to pump the cruise lines. So maybe things aren't as good as people say they are. Why would they, if they're so full, why are they offering such incredible discounts? I guess they're worried about being able to keep those boats operating too. So guys, this is coming to a head, and this is secular. It's not cyclical. And, you're looking at, multi-decades to kind of reorient this economy and the drag that's going to be caused by, 40, 50, maybe 60% of the population not working. Okay. Think about that for a second. Not working. In 1930, you had 75% of the population was working. Okay. We're now in a situation where we're going to have more than half the population that'll be not working, either disability, retirement, or unemployed. And you can't have a functioning economy at that rate. So something's got to give here, and it's going to have to give big. So we have to see which way the Jenga is going to fall, Phil.
Guys, let us know your thoughts on these charts below. Leave us a comment. We appreciate all the views and all the comments as well. And if you're interested in what we do, head over to tradegenius.co. You can get into the rooms with us if you want to start managing your portfolios and get hands-on. We can help you do that. Navigating these markets is going to be pretty wild this year, going into next year as well. So head on over to tradegenius.co and check out what we have over there. Otherwise, thanks, Bob. We'll catch you guys on tomorrow's video. Take care.
Trade Genius.